It's Friday, May 9th, 2025, episode 264. I'm Patrick Ceresna. Kevin still out enjoying his taxpayer-funded escape room, cleverly disguised as a jury duty. And last episode, we had Chase Taylor raising the show's intellectual bar. This week, I'm doubling down on that strategy by bringing in Vincent Deluard from StoneX. Vincent's here to inject some actual expertise into the conversation, while my main contribution will be to expertly timed nodding and thoughtful sounding grunts. Afterwards, Vincent is sticking around to talk some charts with me. So let's dive into this. I'm going to crack open a beer and I'm going to give some disclaimer here. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics covered in the show. Side effects of too much market huddle may include quantitative queasiness, flash crash fatigue, and breakdown disorder. All right, Vincent, welcome to the show.
It's an honor. I have some huge shoes to fill in. I think
Absolutely.
we'll average down the intellectual level after
Oh,
last week. You averaged up, you know.
Yeah,
I'm
gotta
reverting to the mean.
blend it a little bit.
Exactly.
All right, listen, before we get to some talking charts, I just want to, a lot's been happening in the last 2 weeks. We had jobs numbers come out. We had the Fed speaking. We're going to have inflation numbers coming up. And I just wanted to kind of get your thoughts as this unfolding reality is unfolding before us. What's going on here? First off, I want to start with just talking about the Fed, right? So their focus remains on this stagflation, stickiness of inflation, forcing them to keep interest rates unchanged in a wait and see mode, while all other global central banks that typically would be synchronized with the Fed are all cutting. How do you size this all up? What's going on? Is there a Fed policy error here? What's your interpretation of all this?
So this is how I expected things to play out. So I was not too surprised. I think, listen, the market now has a long history of inventing recessions and then projecting non-existent cuts into the curve. Sometimes the Fed plays along and gives them some food. Sometimes it's just the market doing it itself. And I always thought that obviously May was completely, out of the table, but like the June was 2/3. I mean, we had a note telling clients, take the under. And the most important part was the Fed, I think, mentioning Powell saying that there's a scenario where there's no rate cut at all. So are they late? I think there is a chance that they are. I mean, just by virtue of what Powell said, where he said, I want, it's like St. Thomas, who wanted to touch the wound of Jesus before believing he was back. He wants to do the same thing with the economy. Like, I'm only going to start cutting after he's bleeding and crucified. It's like, oh, well. So, yeah, he told us he wanted to be late. Now, he may change his mind and come back to his ways of September, the 50 basis point cut for no good reason in September. But yeah, as of now, I would guess the Fed told us and they told us that before. If you look at the March summary of economic projection, they basically said we think tariffs are stagflationary, and we think that all else equal, they raise the R-star, whatever that thing that doesn't exist is. But I would say that it's somewhat backed by the data. So I'm a big believer in tax collection. I don't pay a lot of attention to GDP or PMI, all these things. I look at the daily treasury statement. I actually had yesterday a long conversation with Kevin on Bloomberg on how to use his data best. And I'm glad that he's also fiscally obsessed. So on that, I know I can feel in the shoes. And the tax collection data suggests that, I don't know why. It was really strong in April. And April is when people pay taxes, and they pay a lot of taxes. Now, maybe some of that are capital gains from last year, but we saw that even in employment income and with that. So something's going on with the economy. My my playbook for 2025 was that we ended super strong in Q4 of 24, and the economy was slow because the fiscal impulse was negative. We'd have the slow and variable lag of monetary policy finally hitting. It was playing out like that in Q1. We saw my tax data was weaker, February, March. Certainly, we had this growth scare. Everything looked the way I expected, kind of, slowly falling into stagflation, not necessarily recession, but stagflation. And then I don't know what to make of the rebound in April. There are basically two theories of the case. One, it's an illusion. It's basically people are rushing things out ahead of tariffs, and then in 1 month, this will go away and we'll go back to trend. Or the one that
Yeah.
I would not rule it out is that, hey, we lived with we consumer kept consuming despite COVID, despite the Russian war, despite mortgage rate at 7%, despite the Silicon Valley Bank, despite the SAM rule. Maybe this whole tariff thing won't matter all that much, and maybe the economy is just going to power through this. Um, Despite all these headwinds. And I think that's what Powell's trying to suggest, that he wants to keep his options open.
Now, I mean, there's two elements. There's the actual impact of tariffs on the economy and consumers. And then there's the secondary effect of everyone trying to plan for potential tariffs. And therefore, businesses may potentially hold off on capex spending and do all sorts of other not do the additional hiring, all these things until they have clarity on what actually the new kind of global front will look like. Like, what are in your minds, the impacts of these tariffs that are going on? First of all, what do you believe is kind of the strategy? Is this all just about negotiation, or is this an actual goal of collecting money from tariffs? Like, how do you size this all up?
Yeah. So on the tariffs, I'm with Kevin. That I think he needs to be taken seriously and literally. Like, it doesn't mean that we'll end up with 145% on China, but we're not going down to zero. And the primary goal of tariffs is the external revenue service. He
Mm.
wants to raise money for the government via tariffs. This is not just a negotiation ploy, and I have no idea what the end result will be, but it's not going to be back to free trade. We'll have significantly higher tariffs. How much revenue we can raise? Right now, the effective with the Trump tariff, so we'd go from 3% tariff rate if we have the crazy Rose Garden formula tax on penguin tariffs.
Yeah.
We'd be looking at 23% effective tariff rate. We have about um, 3 trillion in goods export, goods import. So some exemptions, whatever, we'd be looking at raising $600 billion from these tariffs, up from 100 billion a year. So that's a big number. My guess is that this number is going to finance some other spending. Otherwise, that would be frankly, one of the biggest tax hike in U.S. history, and I don't think that's what Trump wants to do. So at the end of the day, I think that the net effect of tariff will be to raise revenue so that we can do the political thing and tell
Yeah.
boomers, hey, you don't need to pay taxes on Social Security, no tax on tips, no tax on overtime. So we're effectively shifting the tax burden from boomers, low wage workers, onto tariffs, onto consumption. And net, to me, that's it, double inflationary blow, right? Because tariffs, I mean, I know all these smart guys who tell you no, tariffs are not inflationary. I'm dumb, okay? If you take the price of something and you double it, I see that as inflationary, okay? Like, especially if the
Okay.
currency is selling off at the same time. So there's one inflationary blow there, and then there's the second effect, which will be hey, all your uh, Gen Z that are working as bartender, no tax on tips.
Yeah.
No boomers are going to take on cruise. So to me, you're really hitting both sides. And also from a pure efficiency of government taxation, you're replacing something that's super efficient and hard to evade, like social taxes on Social Security. Like, the government pays it to you, so That's fantastic, and that's growing very fast because the population of boomers is exploding with one of the crappiest tax in the world, which is tariffs. I mean, there's a reason why typically as governments kind of develop over time, they start indeed like Trump was saying in the 19th century, we got all our money through tariffs. And then you realize it's not so efficient. We can get more money in a more predictable way by taxing income, capital, whatever.
Yeah.
So we are again turning somewhat Brazilian and walking back. And that means that it's very hard to over time tariffs erode, while the things that we are funding with them, which is basically more money to boomers, grow at 10-15% a year.
Okay, so now the question. Okay, let's actually come back to that inflation topic for a moment that you were suggesting, because I don't think anyone disputes that rising prices are inflationary. I mean, this is like a basic economics thing, but when you look at like the type of inflation that comes from a monetary driven thing like money supply expansion, credit expansion, that's almost sustainable. Tariffs, would you know, agree with the statement that tariffs are the very definition of transitory inflation, right? Like this idea of it's going to cause the numbers to be high, but it's not going to be high on a sustained basis. It's going to be almost like it's going to rebalance itself at a higher level. Unless they're going to keep raising tariffs over and over again, then this is only going to be a short term impact. And when you look at things like long term bonds pricing in inflation expectations over the long term, I can't see this kind of having a long term impact on inflation. Is that, am I off base? Do you have a different view than that?
No, in the sense that, yeah, I agree. It's a all else equal, I agree with you. One time adjustment in the price level. But I would say that every inflationary era is just a sequence of one time adjustment in the price level, right? In the same way that every forest is just a collection of trees. Uh, and you can just
But
say,
some
oh,
trees are bigger than others. Okay, but
yes. But that's, and I have a lot of, super smart friends who, I've had these clients who had this conversation and they keep telling me, no, but look at the CPI and take off this and take off that and take the 3-month annualized of this. And then you realize that it's not. I'm like, yes, but in 3 months, you'll have the same conversation about something else. And that's the point about that I'm trying to make about
yeah,
inflationary era is that when you have an inflationary era, everything becomes inflationary. Every shock, you could have said the same thing, like COVID. Yeah, okay, one-time shock, right? It was the same thing. Russian invasion, supply chain, one-time thing. Biden deficit, one-time thing. Tariffs, one. Why does it keep happening? It will keep happening. I don't know what it will be after that. I agree with you, all else equal, but maybe it's because everybody agrees with that and sees it as one time. So I'm not going to react, right? This is very much what Arthur Burns did in the 70s, and at the time it looked right. Like, why should have Arthur Burns, made mortgages more expensive in the U.S. because OPEC had done an embargo on Israel? It could be like, yeah, this is just repricing oil prices. I'm just going to see through that, right?
yeah.
Um, but then it kept happening again and again. Central bank keeps saying, oh, it doesn't matter. And that's what creates this secular inflation. So
Oh,
my guess is, yes, tariffs should be a one-time price shock, but there will be something else that will come after that will be inflationary. My guess is that it's going to be fiscal. Something big is going to happen on fiscal. I don't think Trump can let this train wreck continue without reaction. I, he's not going to get the deals that he wants.
yeah.
He's not. The stock market pooped all over his plan. The bond market didn't like it. He needs to come up with something, and I think it's going to be fiscal.
Well, I mean, that's been the trend for the government for the last 4 years. So I don't see why that should stop anytime soon, right? The so Now, are you in the camp that the market is overestimating recession risks, or do you think that like, I mean, obviously each analyst has a different metric of what the percentage is. I use the completely neutral thing of looking at poly markets, where basically it's the betting markets where people are putting money. So why not, and right now the chances of a recession, at least by people putting money on it, is over 50%. Now, would you take the over or under on that?
Probably the under, but it's not a very high conviction call.
Okay.
I think I have greater conviction about saying that global growth will be better than the so for example, the IMF just came up with their spring meeting and their World Economic Outlook, and they just trashed their projection for growth. And I'm like, guys, to me, this was like a political move because they hate Trump, they hate tariffs. But I think we'll be surprised to see that nature is healing. The weak dollar is, tremendously helping LATAM.
Yeah.
The fact that Asian currencies are rising, like the Taiwan dollar, is going to help consumption. The fact that Europe is spending again. The fact that energy costs in euro, amazing. Like, okay, look at Brent in euro, or even better, nat gas out of Amsterdam. The whole story that the German industry was going to die because of the well, now they
Yeah.
have margins again. So my guess is that global growth will surprise to the upside. Uh, Probably the U.S. as well. But I have somewhat less conviction because again, I worry, all else equal, and again, that's a very hard thing to say because all else is never equal. But we have a tightening of policy in the US. I mean, if nothing changes, we have a very big tax hike. On the spending side, the federal government, we can't seem to constrain this fiscal spend, but at the state and local government side, it's going down a lot. Like, we used to have this
Yeah.
boom in state and local government spending. That's over. We're gonna have some sort of an effect from Doge in September. We're gonna have the student loan stuff. There's some also HUD, FHA change on housing. So there is a bunch of policy that will tighten conditions. We have a lot of debt to roll over. I think a lot of the companies still, average corporate loan is 5 years, right? So
Yeah.
everything that we issued in 2021 at these super low rates needs to be rolled over. So there are a lot of reasons why I would expect the US economy to slow down. And on top of that, you have this kind of act of God policy risk of tariffs. So that's why I'm more hesitant on the US than I am the rest of the world. But I would just say that in general, a lot of people have made that mistake again and again of underestimating U.S. growth, and it looks, based on what April's done, it looks like maybe the consumer is going to consume through this.
Does your economic outlook for the globe versus the US also equally translate to the fact that you would favor being long global equity over US equity? Are you in that same camp of being long Europe, long Nikkei, long Latin America? Like, is that your theme?
Yep. Yep.
Okay. Well, we'll talk charts then. We'll like when we'll get that up, and we'll take a look at a bunch of these charts, and we'll take a look. Actually, not right now, but we'll take a look at some of these different things as to where you stand. But I want to nail a bigger question. Okay, like so many people are today like, okay, I still am leaning more towards the idea that this market correction that's underway has still something to play out into the summer, and that there's vulnerabilities on the intermediate time frame to the downside. But so many investors are focused on the tariffs and what Trump says as the kind of trigger of what's going to cause the next leg down. And my argument as a trader always is that whatever everyone is focused on and is not going to ever be the catalyst that actually causes a market drop. It's always the thing that you don't know, that you don't know, that one variable where there's a vulnerability that isn't on page one of the newspapers, but on page 16, as Kevin always says. Right. So when we talk about market vulnerabilities, that thing that what is the things that people that the media is not talking about, that are the kind of soft spots, the vulnerabilities in the markets that could end up being what causes stress in the markets, let's say over the next 3 to 6 months? Do you have anything in mind?
Um, but I agree with your presentation and the risk. I would be in the same camp that there's probably do we make a new low or do we retest? I don't know, but I would guess also with the timing. I think the timing is about right. Um, um, I can't tell that it's something that the market doesn't have its eyes on, but I know it's going to come back. To me, it's that you got to watch a 10-year yield. You got to watch bond yields, and
Yeah.
the stock market is a derivative of the bond market, and the um, we don't have a big buffer, right? I mean, today we're at what 4.3 on the 10
Yeah.
year. Um, not impossible to see 4.7 in a couple of months. And that to me that would be the one that would get the second leg going. I mean, we still don't have a budget. We still don't have an agreement on the debt ceiling, but eventually we'll need to have one. The deficit is running much larger than what's despite what I said about taxes being really strong, despite what I said about tariff money rolling in, despite whatever Doge did, which may have been nothing, but the deficit today is the same as it was last year, even though we
Yeah.
had the best tax season ever. And we want to spend 150 billion more on Pentagon, and so um, and the buffer on the yield is very low. So my idea is that bond yields would start drifting higher and higher in the summer until they become a problem for the stock market again, and that would be a trigger for the second leg of the bear market.
Right, right. So, the uh, when we're when you're talking about yields, obviously treasury yields are the kind of point that you're talking about and the stress points. But I want to touch on corporate yield, particularly, let's say, high yield junk bonds, like high yielding bonds. Obviously, credit spreads during the April event finally blew out on the upside. The first we were basically at 10-year lows on some of the different credit spreads back even at the start of the year. And uh, the question is, does this in your mind also translate to uh, there being big stresses in the other parts of the bond market, right? Like, are we going to be in a situation where default rates could rise on some of these very poorly capitalized companies that are over indebted? Like, do you think that these are stress points? Is this really just a government bond issue, and the fact that the government is spending this way, and where are general yields at the government level? Like, how do you kind of size this up?
This may be my bias because of the time I spend looking at fiscal and the traditional account and what. So I don't spend a lot of time looking at that corporate balance sheet and
Yeah.
analyzing bonds and spreads and what's pricing and what's not. So my default would be it's primarily about the, the treasury, not the spread, but of course, um, one could feed the other, right? I mean, we have all these debt to roll over that was issued at low rate. So if you have to refinance much higher, that can create stress on its own. Another area that would worry me, but I unfortunately don't have a lot of insight to share is we've seen this explosion in private credit and private debt, and I wonder if that's not where the um, basically added something like $1.5 trillion. That's bigger than the whole junk market to private debt strategies since COVID. And these things on paper, they still work well, but you hear reports that, oh, maybe there's some
Yeah.
stress there. So maybe it starts there and then it spreads to the junk, to junk bonds. And that's how it tightens the economy.
Well, yeah, no, Kevin's talked about the private equity bubble in his mind as well numerous times. And so it'll be really interesting to see whether cracks start to emerge in those kinds of areas. Because, at least in my mind, I don't think that there's I don't know what Trump would have to say that will now shock the markets into another leg down. I think that it's going to now start to be actually on fundamentals. That the next leg down is like when the realization that the economy is weaker and that there is the knock-on effects. I think it'll be something driven by some negative feedback loop of something that could potentially be what drives the next leg down. All right. Well, Vincent, are you up for it? Let's talk some charts. You good to this?
I'm good.
All right. Listen, what I want to start with is we always cover what are the top three things to watch in the coming weeks. And no, really, to me, these are all data points because obviously the jobs numbers came out last week. And while JOLTS and ADP were a little bit on the soft side, on that front, but the much anticipated kind of break in jobs numbers didn't emerge on the Friday jobs numbers. First of all, like how do you size up how the jobs numbers came in, and do you agree that like watching these kind of data points as to when are we going to see some economic weakness starting to really emerge? Is this what we should be watching?
So I expected a higher than average, higher than expected job market, because primarily because of tax data. I could see that economic rebound. We could see it in the tax data, also unemployment paid by the Department of Labor. So I'm not surprised. As far as where I think it comes from, um, I think it's the behavior you were describing earlier for companies where they're just like a deer in headlight. Oh, Trump can say one thing, the next thing to the
Yeah.
next. So I think that the default is just to wait and hoard labor. I think corporations learn from their mistake during COVID when they let go of their staff, and then they had to, you know, compete very hard in 2021, 2022 to get this Gen Z and like, oh yeah, bring your pet support dog to the office. Yes, you can work from the swimming pool, pay, all these kind of uh, lazy girl job, quiet
Yeah.
quitting, act your wage, all that insanity. So I think in a weird way, like the US is becoming more European. That's something typically seen in Germany, right? Where you have, if you
Yeah.
have a hit to demand, corporation just tell that, okay, stay put, maybe get some part time, we'll keep you on payroll, things are gonna come back. And the US used to react much faster. Maybe now the US is more like Europe, um, which can cut both ways. It can also mean that at some point, if they do realize, oh, tariffs are for real and there's a slowdown, then you have to let go of more people. So
Yeah.
maybe the next job reports, and that's kind of part of also my scenario for things to get worse in the second end is, um, yeah, at this point we can probably eat it and just wait. But the more it lasts, the greater the chances that we have to kind of make up for that.
Right.
So sorry, what was your question?
It was just really how the jobs numbers reactions to it, and as well, well, we can just move on because yeah, you did answer the question. I mean, it was just about the jobs, but we're watching the retail sales, which are coming up next week.
Oh, I think
Um,
my guess would be I'd take the over on that. Things that I like to look at are open table dinner reservation. They were really strong. Red Book index of same store
yeah,
sale really strong. Tax collection really strong. Having anybody who wants to spend money, wants to do it now
yeah,
before the tariffs are over. It's summer. The sun is out. People, yeah,
yeah.
never underestimate the US consumer's ability to put stuff on the credit card.
There you go. All right. So number two, I want to talk about, and not next week, but the week after, we have all the flash manufacturing and services PMIs, not just in the U.S., but actually many European ones and so on coming out. Do you think that the kind of economic slowness in Europe will continue to persist, and how do you think it all comes in? Do you have any opinions?
Okay, first of all, I'm really not a PMI guy. I think it's it's a horrible data point. All it tells you is, whether
Yeah.
these guys, survey 50 guys, whether the stock market is up, and it's really completely circular. This obsession with PMI, uh, and I don't follow it. To the extent that I'd make a bet, yes, it would be that it's stronger than people think in Europe. Um, or uh, summer in Europe, people go to the beach, they spend. Americans are still coming
Yeah.
to Europe. Obviously, I mean, yes, euro is 1.1, but it's still pretty cheap.
Yeah.
Europeans are no longer coming to the US. I think that there will be a shock in the US. Like a lot of obviously Canadians are really, really pissed, and I mean for good
Yeah.
reason. So yeah, I think we'll have a great tourism season in Europe, and I think that will boost activity. We have good news on Germany spending again. So yeah, I would take the over on PMIs in Europe.
Yeah. All right. And the number one thing to watch is obviously the inflation numbers, the CPI and PPI coming out next week. And so the only thing that on my mind here on the inflation numbers is this the month where we're going to start to see those price increases, even if it is transitory or not? Is this the month where we're going to get a hot print, or has already the forecasted numbers that people are anticipating already baked that in, or you think this is going to be a beat on the upside?
That's a hard one. So I look at the tariffs, the revenue collected by customs, and it hit last month. So if they get it around the 22nd of the month is when you see these bumps.
Yeah.
And they usually get like 5 billion. It's more 11 billion. So tariffs are being paid. So my guess is we'll see it in the data. Now, will we see it more than the market expects? My default is I'm an inflationary guy, so I guess so. But I've kind of refrained from making bets on CPI short term.
Yeah.
It's really hard. I mean, at the same time, shelter is coming down. There's a possibility that we see shelter come down, rents, OER faster. So you really need to really understand how the index works. My guess on
Yeah.
inflation, I prefer to hide at the long end. If you
Right.
ask me to predict inflation next month, I think it's kind of fool's errand, and
Oh,
it's 50
okay.
50.
So let's not actually talk about what the inflation number will be, but rather the response mechanism, because obviously the market has inflation on its mind because they all know that tariffs are going to drive higher inflation numbers. So, what is it that you believe that could potentially happen to the number that would warrant a response by the market, like where we come in and we see the market freak out and not like the number? You think it would that be a hot number that comes in too high? Is that what would drive a market turn? And how hot would that number have to be in your mind in order for a market to kind of be outright disappointed by this? Do you have any speculation on this?
So the expectation, I think, is for 0.3% month over month. So anything above that would constitute a negative surprise. I guess the market would be more indulgent if this surprise was driven by core goods, things like we buy from China. But, okay, just a tariff impact.
Yeah.
Who knows what happens? Trump will get a trade deal. Um, if it's driven by your super core, um, especially like, I mean, it's been so sticky, so sticky. Every podcast I do, I keep going back to my haircuts indicator, which I think is great, and I'm gonna do it again. Again, if forget all the 3 month annualized this X that, if you want to know where inflation is going, look at the CPI for haircuts, and it's fantastic. It's not adjusted for hedonic adjustment. It's not, there's no tariff, there's no China, there's no Russia, there's no shortage of this, there is no AI, there's no chat GPT. It's just how much does it cost to hire someone who hasn't gone to college, rent a small retail space, and pay a bit of insurance. And there you can really clearly see what I've been talking about for 4 years. Is before COVID, we're at 2%. Now we're at 4%. And it's really not coming down. So
Yeah.
if we look at this kind of core X, X core good, X goods, X energy, right? Which we agree is probably um, what we should do for sticky
Yeah.
inflation. You got this push and pull dynamic between shelter that's going down, and then these core services that stay at that 4-5% level. And I think one reason they stay at that 4-5% level is because insurance costs are insanely high in the US and they're not properly measured into the CPI. I mean, I live in California. I see the huge increase in premiums after
Right.
the fire. People in Florida in the South tell me the same thing, because of the hurricanes down there. So to me, that's accumulated inflation that will want to to show up. And Yeah, if that's right, I think that's what the market cannot really brush it off the way it
Right.
can say, "Oh, don't worry, it's just tariffs. It'll be over in a month."
Right. Right. Okay. Let's talk some charts. All right, so we got to start by talking about this S&P 500. Obviously, we had a very challenging March and April month that saw one of the fastest declines of outside of the few bear markets that we've had over the last couple of decades. Right, so we wiped out 21% on the downside in a pretty clear fluid motion, and a short-term low comes in, and since then, the stock market has been in a rally. And the big debate is this a bear market rally, or was the bottom already formed? And now, just like a COVID bottom, this thing starts to progress higher from here, and it's all behind us. I'm obviously in the bear market camp with that, and another leg down. But first of all, are which one do you kind of lean towards on there? And the second question to that is that if I'm wrong and this market does progress higher, what would be, in your mind, the tailwind behind a market that will continue to bull if my thesis is incorrect?
I'm with you. I I think the tops are long processes. I wouldn't. The COVID stuff. It was so weird. Yeah, that was a clear, V-shaped bottom. But again, it was such extraordinary. Like that, I don't think it
Yeah,
really applies. Uh, to me, we're still in this kind of topping formation, and it can be painfully long. And they are retracement, and there's nothing extraordinary about this retracement. We retrace about half. Typically, we retrace 2/3.
yeah,
So I think we could go to the whatever
yeah,
Fibonacci retracement level.
exactly.
If that's your thing, maybe that's a good target there. Um, Remember, wait. I mean, it was so long, right? I mean, we had the first.
Yeah,
I mean, the Burstern blow up was at what, February of 2007, right?
yeah.
And then the market kind of tread waters, makes a marginal new high in the summer of '07. Um, and then even the first half of 2008 was quite good. I remember
Yeah.
where's the big
Well,
hit
that
at?
was the crazy part, right? So this is what you're talking about, the Bear Stearns blow up. We had about a 12-15% decline in the market, and the market managed to still make a higher high in
Yeah,
October, in
yeah,
spite of the fact that we already have subprime blowing up. Banks were already 20-30% off their highs, and still the market was hovering along those highs. But the part to kind of respond to your analysis is that here we had about a 20%
yeah.
market
But
decline.
then Q1 of Q1 Q2 of weight is not bad at all.
Yeah. And more importantly, that was almost, well, from the depending on which low you want to go, but let's say the lowest level that was from the kind of crash drop, it took 118 days, 4 months, that the bear market rally lasted as it retraced. And so, here we are, literally just 1 month
Right.
into
Right.
into this bounce, but we've already retraced half of the losses. So it's one of these kind of puzzle pieces. Well, there probably, if our thesis is right, there probably is only a limited upside, but maybe
Yeah.
no immediate catalyst to go down. And so we may end up spending the entire second quarter chewed up in trade ranges,
Yeah.
kind of failed rallies, fake out breakdowns that sucker short sellers back in to only have it rip back up. Like it could be messy. I mean,
Can I plug my research shamelessly?
yes, please do.
Thank you. Thank you. I know we're all here to make money. So my 2025 outlook published in December is called Beware the Ides of March. And I probably never have a better time title and all that. So, and then as I saw and to be honest, I did not expect the tariff to be so crazy. Like that was just
Yeah,
icing on the top. My
yeah,
case was just, it was going to look stagflationary anyway, kind of things that I talked about, the negative fiscal impulse, blah, blah, blah. I mean, so I saw the tariffs by early April. I was like, okay, guys, I published another report, which was called Spring Rebound, Summer Lull, Fall Correction. And I think that's exactly what you described. It was so oversold, right? By mid-April that it's like, okay, it's gonna bounce, and I think we got that spring rebound, and now we're kind of transitioning into that summer lull area where,
yeah.
yeah, we remain range bound. It's not very interesting. People, in the summer, people go to the Hamptons or whatever, and then the real action happens in the fall, and then depending on where the economy goes, I suspect it's gonna be going down, but and then that's where we retest the lows. That would be
So
my playbook.
The question I have for you is this. So typically, market corrections are not bear markets. Typically, correct when the multiples get too high. Again, everyone gets a little too frothy. The market just mean reverts back to a more normal level and then kind of resets and starts up again. And that's a market correction happens once a year or on average, whether it's 5 or 10%, but they happen frequently. But when you're talking bear markets, whether it's 2022, whether you go back to the financial crisis, whatever, there usually has to be a genuinely fundamental driver behind sustained decline. And now 2022 was really a bond bear market that
Mm-hmm.
dragged equities down. Right, like that was, everyone looks at it from an equity, but I'm like, no, it was,
Yeah,
it was
100%.
a bond bear market. Now, in this sequence, or at least in typical recessions in the past, you would see corporate earnings contractions, and that when we see that expectations for guidance and everything start pulling back, then they start pulling multiples out for what they're willing to pay for these stocks. And those are the kind of scenarios where you could see 30% off the highs, 40% off the highs on the stock market. Is your September scenario driven in your mind by corporate earnings being a contributor to a deeper correction, or is it just really this yield story that you're talking about? Like what do you, or obviously both of them could be happening at the same time, but like what in your mind, when you're constructing this, you obviously did your analysis on this. Now, how do you envision the catalysts being, or the drivers for a deeper correction?
It's both. It's both. So let me start with the yields. 100% on your point being, 2020 is a bond bear market that spills over into equities. I think we haven't done the full spillover yet. Like, I think the equity market still thinks, if you look at their long-term cost of capital, it's not where it needs to be.
Yeah.
It's not ready for what I think is the real world, which is, yeah, maybe in your dividend discount, like, risk-free rate is 5%, because inflation is whatever, 3 4, and term premium is structurally higher and all these things. So I think there's still a bit of juice from that. They still, excessive bets on all the Fed's going to cut. You see that in the Fed funds futures. So there is some of that 2022 juice left.
Right.
And it keeps coming back. Right? It's like in a bad movie where the dead guy won't, like the ghost of the secular stagnation, lower for longer, is still not fully dead. In the same way that the ghost of the high inflation in the 70s kept haunting the market in the 80s, the bond market vigilantes, whatever. Like, but we had hypersensitivity to anything that saw inflation in the 80s. I think we have hypersensitivity that anything that sounds like low rates now, and we need to fight that, and that means that you need progressively your implied cost of capital needs to go higher. So that's the first part, and the second part is exactly what you indicated on earnings and margins, especially. I mean, there's this big debate why the U.S. exceptionalism, why U.S. companies so much more profitable than the rest of the world, and you know being Americans, it's obviously because we're better than everybody else. I mean, that's obvious, right? We
Obvious,
you know.
obviously.
Uh, I would be open to the possibility, and I'll just suggest like a crazy hypothesis that the 7 billion or so humans that are not Americans are not structurally dumber, and their politicians are not as may not be structurally dumber than the obvious genius that are currently running the White House, but that the maybe the reason why U.S. margins were so high is because we're the only country in the world that kept running a deficit of 7-8% of GDP 5 years after COVID, and that this abnormal deficit fed into the margins of companies that
Yeah.
maybe even directly contract with the U.S. government, and if we also benefited from basically free capital. So we had a much lower cost of capital. We had this massive effective subsidy from the government. I see both rugs being
Yeah.
pulled at the same time. Foreigners are no longer wanted to just just by Microsoft and Nvidia. So we lose our access to cheap capital at the same time as we need to get real on deficit. So at least maybe the deficit keeps going, but it's no longer painless because we finally sucked out all the liquidity from the reverse repo facility. We no longer just can sell
Yeah.
it to foreigners, so we actually have to compete for capital. So the cost of capital goes up, and we realize that this 13-14% S&P margin were the exception, not the norm. And Yeah, if you look at how EPS expectation are, I think short term people have written it down because of tariffs, but it's the idea is that
Yeah.
EPS is going to rebound in Q4. Uh, my expectation is going to be the opposite. In Q4, it's finally when it hits.
Right.
Maybe we still have like a little bit of, because people sell inventories or whatever, they adjusted the tariff pause. So maybe we still get, because earnings this season have been great.
Yeah.
Maybe we have one more, but the more time passes, to me, the more the likelihood becomes that we see these margin come down.
Right. And it's really, I think about when the guidance has to be adjusted, like when these companies finally say that you guys are the bar is too high, we're not going to clear this, and they start guiding lower.
There's an
Like,
enabling effect. Like the moment you
yes.
see a couple big companies do it, it's like, okay, now it's okay. Now we can talk about it. It's almost an
Yeah.
overtone window. Everybody does it, and then that's when people start laying off, and that's when
Yeah.
the recessionary dynamic starts to play out. Again,
Yeah.
my guess is that it probably like when they report Q2, maybe they start getting lower for Q3, Q4. Maybe that happens when we report Q3 in Q4,
Yeah.
but it's around that time.
There you go. All right. So let's overall just leaving the stock market. Well, leaving this topic, I want to just touch one thing. What would you view as a realistic expectation for a downside risk of this S&P? Like, are we just retesting lows around 4,800, or I've heard some quite bearish views that we're going to go 4,000 on the downside of the S&P. How would you, like, obviously you're biased that there's another leg down, but what's the severity in your mind that you think is a downside risk?
Mm, I'm bearish, but I'm not that bearish. I would say, yeah, that 4,800 number you suggest is, so yeah, 4,800 on
Yeah.
the S&P
Yeah.
is probably where it needs to be. So we retest, maybe go a little bit lower. But again, I'm not in the recession camp. So
Yeah.
if you don't think there is, or maybe there is a recession, but it's kind of a 2022 recession, right? Oh, two
Yeah.
quarters of negative GDP, but not everything turns at the same time,
Right.
or maybe like 2000. So it's like this big 50% plus decline like we had in 08, like we had in 2000, typically happen with a
Yeah.
recession. So I think top to bottom, so going off the February peak, maybe 25-30% from the top. So that would probably
Yeah.
take us in that 4,800 range that you mentioned.
Yeah. Perfect. All right. So let's move on to the US dollar. And so let's start here with the chart on the US dollar index. And what it was quite the doozy of a drop that basically is now has the dollar having broken below that 100 level that acted as a very key low throughout the last 2 years. And not only did we break below to a lower low, but the bounce, arguably, in the last month off of the low is nothing short of pathetic. To me, there's a reflexivity in markets, which is why the stock market shot up 10% in one day after it dropped, in violently. There's usually some sort of proportionality. So you would think that with a drop of 5 6 Dixie points in a span of a month, that you would see a reflexive rally that in some way had the dollar making higher, and it's not materializing. Even right now, as we speak, there was that little pop in the U.S. dollar, and they're already giving a chunk of it back. This has been a very weak rally. So is in your mind this kind of 98 level on the Dixie fair value for the dollar, and we're going to see far more stability at these prices even though the price action is weak? Or do you think the dollar is vulnerable for still even further lower repricing, like maybe we see 95 or lower on the Dixie? What are your thoughts?
Lower, um, I see it as I see that as a good thing. Um, the dollar has been too strong for too long. The only way we solve a lot of these global imbalances is to have a weaker dollar.
Yeah.
That would also help cushion the economic outlook. I mean, basically, if you go with a dollar milkshake and euro dollar, all these guys you had on the podcast, and many of whom are friends, uh, it's a very dark scenario. Where the dollar wrecking ball. I tend to be a little bit more optimistic, and I think things that are unsustainable are eventually are not sustained. I don't really believe in doom loops, and think economies adjust, more humans figure it
Yeah.
out. One way or another, we need to get that down, the dollar down, and I think, yeah, we are, that's what's transpiring. There was this
Right.
view that the tariffs would Trump won, the dollar went up on the tariffs, right? The tariffs would be the trigger for the dollar to just going parabolic and break down the world economy. It's the exact opposite. The other thing that I'll point on the dollar is, these moves, and I think that's the logic behind the driver behind what you said about this crappy bounce, is these moves are self-reinforcing. So why is the dollar going down? Because foreigners are freaked out and they're putting money away.
Right.
As they do that, it brings the dollar down. Now, these foreigners, who are they? They're an insurer in Germany, a pension fund in Japan, a life insurance company in Taiwan that bought treasuries that are hedging that. Now suddenly they look at the P&L and they see, holy crap, like my US position, why am I doing this? It's underperforming my index. The currency is killing me. The regulator is breathing down my neck. The politics are horrible. Yeah, I'm gonna, and these guys are all loaded US. I mean, that's my job, is to talk to pension fund in Latam and Canada and in Europe. And I
Mm.
spend all my time talking about the US. When I talk to a US pension fund, I don't, the reverse is not true, right? I mean, this is a one-sided love affair here.
Yeah.
So that movement of bringing capital back is self-reinforcing, and this is why these dollar cycles are so long, right? You can break it down in decades almost, like
Yeah.
since 2011, dollar up, everything international down, and you can every decade before that was the opposite. Right? In 2000, it was the BRICS, it was the EU enlargement, a decade of outperformance international. 90s, the exact opposite. Internet bubble, Mexican tequila crisis, East Asian crisis. In the 80s, we had the plaza. So it almost fits decade by
Yeah.
decade. My view is we are in a decade of capital repatriation, weaker, and again, it's a good thing. It is healing the world. That's what the world needs.
Right. So we here's the monthly chart of the U.S. dollar index going back to the 80s, and what we saw was the two significant U.S. dollar bear markets that happened. The one in the kind of post Reagan period or Reagan
Plaza, yeah,
period,
plaza
and
basically.
yeah, exactly. And then you obviously had the 2000s, which was an
Rise of the
extraordinary
BRICS.
commodity bull, and so the one thing to highlight is that a lot of people, when you say I'm bearish the U.S. dollar and the U.S. dollar is going to go down, they often are like, oh, you're the end of the petrodollar and all this doomsday. But the thing is, the dollar has lost 30 to 50% of its value on multiple occasions. And it wasn't the end of the dollar system and it wasn't the end of the world. It was just a massive repricing over a decade that was playing that out. And so we have been I would argue, over the last decade, been blessed with two incredibly boring trade ranges of dollar levels, right? Where we've all complacently got used to there being no currency volatility, and the idea that we could return back to a period where currency volatility is back doesn't have to result in some sort of a doomsday scenario, just simply a massive repricing. And so I could see that the puzzle for me to solve, Vincent, though, is that what time frame is it? Like, we got this huge 12-point drop in the Dixie in a very short window of time, but what is where's the money flow for the rest of this year? Because okay, you could make the call that the decade will see, maybe we'll see 80 or on the Dixie or something like this, but what about this year? Like, do we get down into the mid to low 90s in just 1 year, or is this already it's going to be much more gradual over the course of multiple years?
Keep trying to nail me on short-term call, and I prefer
Not to, you're avoiding it. Okay.
undefined, decade plus. uh, Let me first address one thing that you
Yeah.
mentioned, which was these trading ranges, the two trading ranges that you highlighted on the charts. They were not accident. They were the product of policy choices. They were basically central bank coordination, right? You had
Yeah.
the Asians that were basically pegging to the dollar and recycling their surpluses and preventing the currencies from rising. And then you had the Europeans and Japanese at time explicitly coordinating with the Fed, when they had the Sintra Pact, or there was a couple of these arrangements where the central bank coordinated and said, okay, we're going to manage volatility to keep it where it's at. Um, and to your point on volatility coming back, it's very hard to see this kind of cooperation happening going forward, given
Yeah.
the amount of bad blood that there is. And I think we are moving in a world where everybody is on their own, and we're no longer kind of taking one for the team. Yeah, the Japanese need a low
Yeah.
yen, so we'll all help that out. Or yeah, Powell needs to hike rate. Maybe it's not good for my economy to do it now, but we don't want the dollar to go up that much, so I'm going to raise rate in Europe as well, even though it may be too early for me. Like, this kind of calculations were part of that world of yesterday, and I don't think there'll be much of that going forward. So that would argue that the norm is not these training ranges are managed, and if we go unmanaged, we'll see wider ranges. Which, I'm not trying to dodge your question.
Yeah.
I think we can go lower, yeah, on the dollar. I mean, listen, we haven't. The dollar index is a hard one because you got such a huge weight on the euro, which is not the sexiest
Yeah.
of the currencies. But even at 1.1, I don't think the euro is that expensive, right? Same with the yen at 140. We're basically
Yeah.
back where we were 6 months ago. So, um, yeah, I would think um, by year end, yeah, dollar index is lower.
All right. So, for me, I was looking for a bounce that would be a little bit more pronounced, and the fact that it's such a weak bounce to me means that the prevailing distribution and sell cycle is still dominant, and that does continue to make the downside vulnerable. Like it hasn't neutralized itself in any way. Like I would argue that when we look at things like the Euro Stock Index or the Nikkei, with these rebounds of such enormous strength, they've almost neutralized the sell cycles, but that's not evident in the dollar whatsoever. And so the prevailing downtrend is definitely underway. I'm going to talk gold, but before we do, we got to talk about the asset that shall not be named, Bitcoin. Um, but the crypto asset had a big breakout. It ripped almost 6,000 points on the upside yesterday, and broke those fib levels you mentioned earlier. But we now are approaching its December and January highs, and so begging the question, is this going to surprise again with another leg higher on there? Do you have any opinions, or do you generally avoid talking crypto?
I generally avoid talking crypto. I have philosophical sympathy. I see a role it can play in international monetary system, but it's really not my area of expertise. So I mean, what's your take on it?
Well, listen, all I'm just observing is that the breakout was pretty real. Like it was lagging, gold was trending. Obviously, a lot of the people that own gold like to own Bitcoin as well. A lot of them view it as a diversifier, and gold's been running, and Bitcoin was left behind. And the fact that Bitcoin had this breakout in this manner, I think that it will once again get a lot of attention if it can break to an all-time new high. And one of the things I believe that crypto needs more than anything else is momentum and
Yeah,
headline press,
yeah,
and for flows. And if this manages to break to an all-time new high, it could feed that feedback mechanism of buying that could drive a move to 120 to 130,000. So technically, I'm watching whether or not this follows through and manages to break out, because it's going to get once again all the headline press on that upside. Let's quickly change the topic before I get you talking too much of that. But let's talk gold. And gold broke out this week, almost attempted to make a fresh new high on a closing basis. It was very close to almost a fresh new high, and pulled back a little bit, but it's still a prevailing bull trend on the upside. What's interesting is things like silver, platinum, palladium, other precious metals, almost no participation in this. This is very much a gold thing. Kevin makes the argument quite a bit about not argument, but clearly there's evidence of it, of the Chinese central bank buying and other things driving this. But in your mind, uh, is this still mid game, or is this gotten too frothy, and gold is going to run out of momentum? Do you have what's your bias?
long. I mean, it's been like that for several years now. Again, I'm kind of a secular inflation, financial repression is the solution, and we need to fix the global monetary system one way or the
Yeah.
other. So all these things, and to Kevin's point, you're really fighting an elephant here. The Chinese have I think it's around 4% in gold reserve. They probably wanted to get closer to 10. They have the money. So and every time it drops, they keep buying, which is why it's exact opposite. This chart is the opposite of the dollar, right? In the dollar, you see
Yeah.
these bounces and they kind of weak. In gold, the corrections are short and shallow, and the bounces are bigger. So even from a chartist
Yeah.
perspective, I think you can see that in the charts. So um, yeah,
Yeah.
we make
Well,
new
for
high
me,
by the end of
for
the year.
for me technically, this the bulls need to really, like, obviously I'm bullish longer term, just like you, so we're in agreement. So I'm going to just observe some short term technical levels that for our listeners listening. But to me, 3300 that held this morning is actually a pretty important short term level, because so long as the bulls use that as support, rally it back up to the highs, then you want to consider the Bulls playing immediate short term offense. And that 3,700 upside target is still 100% in play. The one thing that ends up happening, Vincent, is that even gold being long term bullish, it enters periods of multi month consolidations like here and here. And what really, in my mind, is that either gold is in the bull phase and it's still ripping, or we've gone too
Yeah.
far too quickly and it takes a break and consolidates.
Then just
And
buy the miners,
yeah, yeah,
because
that's
they're printing money at this, if we stay above 3,000, oh my God. If,
yeah,
if the worst you expect for gold prices is a 2-year consolidation at 3,000.
yeah. Absolutely. The but to me, like if you look, let's say on both of these prior corrections, the market kind of retests the highs and then just sits in a pause. It kind of retests the highs and sits in this trade range. And so to me, 3,300 has to hold, and the bulls need to clear 52-week highs in the next week or two in order for this bull trend to be intact and still going. If we break below 3,300 and are hovering down at the 50-day moving average, it is materially increased odds that the short term run on the upside is paused, and we've entered one of these consolidation periods that may define the entire second quarter as gold kind of taking a break. And so that's. But now I want to talk about your call here on gold miners. I get it. They're going to be printing money at these levels. But generally, there's been an incredibly strong correlation between gold and gold miners. But in your mind, they decouple? Can they almost take over and just run even if gold doesn't move? Is that what you were implying?
Yeah, through the earnings game, it's been very hard to get significant investor interest in gold miners. Even as gold has really gone up. I mean, if you look
Yeah,
at the flows, it's just nothing happening there. So I guess one way that they could make it is just through the quant models of like, companies are looking for positive earnings revision, expanding margin, growing stronger balance sheet. Gold miners are going to start popping up, and that's how they get bought, just because the fundamentals are so good. I mean, could you think of a better $60 oil and 3,300 gold? I mean, at the end of the day, gold miner is that, right? So synthetic long gold, short oil.
yeah,
And it's just the best environment for them. And um, so and they still yeah, they rallied quite a bit this year, but they still lag if you do longer chart
yeah.
since gold started to run. I mean, miners only started to participate 6 months ago.
Absolutely. They literally since the start of the year, they've the moves really gotten underway. So I want to move on to just going back to bonds, because I mean we talked about this. Now, obviously, you feel that the 10-year yield. Let's look at the yields versus the bonds. So the 10-year yield in your mind is where that upside risk is, where it could shock the economy. Now, what the question I have for you is this: first of all, what's your take on the short end versus the long end? Are we talking a huge steepener in the yield curve? And if we are, is it driven by the bull steepening of the fact that the Fed is inevitably going to have to ease, or are you in that bear steepening where you think that this is we're going north of 5% inevitably, and we're going to just see this huge divergence driven by long bonds getting hammered? Like, what, how do you size this up, and what charts can I put up here to collaborate this?
Um, so the curve moved a lot after last week, right? I mean, if you had asked me this question uh, 2 weeks ago, last whatever, I would, when they're pricing this June curve with uncertainty, I would tell you it's the front end that needs to move higher. Um, we've had a lot. I would look maybe like 2026. So 1 year out is probably where sh- the so to answer your question, is not the front, still kind of frontish, but like 1 to 2 year maturity, I guess, is maybe where it needs to go
Yeah.
back up. um because yeah, there's a chance that, yeah, the economy remains stronger, the Fed wants to stay, we keep pushing these cuts out. The Fed's not cutting in June, and then the same keeps happening. There's no cut in 2025, and then so the one that needs to move the most is probably um I think that the low for rates is around yeah, December 2026. We still have a 3% Fed funds rate implied by the curve. That seems wrong to me.
What level on the 10 year do you think we'd have to see for the Treasury and the FOMC and everyone to start being concerned? And like, I mean, are we? Is it just a north of 5% number, or would it have to be considerably higher than that before you'd start getting the all of the important people talking about how we can rein this in?
I think it depends on the market's reaction, right? The market just whistles through it, and spreads don't move, and looks like the economy is fine. You'll be okay. We just reset to higher rates.
Yeah.
My guess is that, based on experience, the market really starts to puke when we get 10 year sustainably above 4.7, 4.8%. And my guess is that it's going to happen again in the fall or in the summer.
Right. So you continue to think, and like you were saying earlier, that this is going to be one of those things that the market's not ready for on that. Now, do you think that this is driven by issuance? Is this driven by the fact that that the foreigners are selling so aggressively? Like, what are the precipitating drivers that will push yields this way?
So we solve the debt ceiling. We refill the TGA. We have to issue a lot of debt. This is again, the reverse repo facility is all but empty, so we're gonna have to take the money from somewhere. Bank reserves, selling assets, and yeah, foreigners are
Yeah.
not buying, don't want to add to it. We have all this noise about a Mar-a-Lago, Zoltan Centennial bond. So who wants to, if you're a foreign central bank, that's not exactly confidence building.
Yeah.
So yeah, and again, we're not that far off. So you could get there in a couple of days.
Now, how much do you follow European markets versus American? Are you predominantly focused on the American markets?
Now I am more focused on US. I mean, for 15 years I followed Europe. Um, it used to be so boring that I almost quit, and now I think Europe is getting interesting again. So I don't know. What do you want to ask me about?
Yeah, okay. Well, like, what, I thought it was really interesting because, okay, we could look at the Euro stock, which was relative here. I'll put on a daily. It was obviously outperforming at the start
Right.
of the year. Clearly, rotation there was going on, but once we got to the liquidity event of the Trump tariffs, we had a very rapid. decline on the downside. Uh, Obviously, there's been a rebound, but what's interesting is that it is a lot of the smaller European equity markets that have been running so hot. Like, let's say Spain
Mm,
uh, uh, dipped, immediately rocketed to a fresh new high. Italy rocketed to a fresh new high after that drop. Greece rocketed to a fresh new high on there. Like, I'd love to I don't know why these smaller equity markets are getting more of the juice on the upside than obviously German or French markets. Do you have a thesis as to why
yeah.
this could be underway?
It's not really a thesis; it just has to do with the composition of the market. I mean, if you know what people say about the Max 7 and the S&P 500, I mean, you can say the exact same thing about Germany and France. I mean, Germany SAP is about 17% of the index, so bigger than I think Nvidia is probably like what 5-7% of the US. I mean,
No.
it's 3 times. You know what I'm saying? Siemens 10%, Alliance. So these are names that in a trade war don't do so good. So that's why Germany is not participating as much. And then for France, it's LVMH. Let me get the exact number on France. Um LVMH is 8% of the index, so a bit less, but you'd have to add L'Oreal, Hermes to that. These
No.
guys get hit by the tariffs real bad, so it makes sense. Or if you look to at
And
Spain or Italy, your biggest players, Spain's probably going to be Santander, BBVA, Iberdrola, which
no.
domestic or Latam, right? That's what drives
Yeah.
them, which is fine in both cases. Spanish economy is pretty strong. Latam, it's my top pick for 2025 is Latam. They mint money over there. So yeah, index composition.
Right, right. So, what now? One of the hottest stock markets in the world has been Argentina, and so we've basically had this thing since Mili's come in. Basically, it's been 2-3 years of this thing going 300-400% to the upside, and it looks like it's about to break to a fresh new high. Is someone late to this game now buying in here, or is this still an outperformance story here?
I don't follow Argentina as much. I would say that if you're worried about being late, then play it with Brazil.
Right.
Because there's one thing that the Brazilians can withstand a lot in terms of looking like fool and
Yeah.
messing things up, but they cannot withstand losing to the Argentines. That's a level of humiliation that's not okay. They can be the joke of the world as long as the Argentines are below them. That's fine. But if you see Argentina getting its act together, Brazil will follow, and you can see the politics already playing out, right? I mean, Lula's approval rating is super low. They just look south of the border, like, oh wow, looks like it working. Brazil has this huge real rate problem that is really a political problem at the end of the day. It's because the central bank and Lula are
Yeah.
butting heads. But if we have this kind of weak dollar, better global growth as I expect, then you play it. Then Brazil is going into election next year. And I think the market will sniff that out. I mean, I'm sure you had my friend Paulo on. He can talk to you.
Yeah.
And what I like about Paulo is that he's usually a big Brazil bear. So when you see him turn like that, and he knows what he's talking about. So I would say if you worried you're late on the Argentina party, buy Brazil. The other thing about Argentina, you have such a big weight on Mercado Libre. I don't know the Argentine index all that much, but I think you get more diversification out of Brazil. It's just a bigger market, bigger.
More
Big,
exposure to commodity
yeah.
stocks, which have been dragging their heels quite a bit. And
Yeah,
the Petrobras and the Valets
Valley.
and everything.
Yeah.
Exactly, all of these plays. Uh, do you is there a particular Latin American market outside of Brazil that's one that's high on your watch list?
I would say Brazil is the biggest
No,
one, and as Brazil goes, it will carry everybody with them.
because it was interesting. The Mexican stock market, which was in a pretty tough bear market for 2024 on the downside, really looks like it's banged out some sort of a short term low and turning up. It's above its moving averages, broke out of the trade ranges. Looks like early innings. You think that this would you basket this in the same kind of Latin American trade as the others?
In big picture, Mexico is a derivative of the US. Brazil is a derivative on China. I am more positive on China than I am US. I think that that bounce in Mexico
Yeah.
was um, Scheinbaum, the president being quite astute in the negotiations with Trump and kind of dodging the blows. But it's it's still if I think the U.S. economy is slowing and we'll have this kind of erratic policy making. I mean, Mexico really gained from the first trade war.
Yeah.
Basically it was we punished China and then French war, and you had this huge boom in Monterrey, Nuevo Leon, super peso. Yeah, there was a 2024 was bad, but if you zoom out the chart, you'll see this fantastic rally of Mexican assets. So to me, the story in Mexico, I see more downside risk in Mexico, or at least the up story has been played out. When Brazil, it has not.
Awesome. I love it. So buy Brazil, everyone. There you go. All right, Vincent. Is there any stock or market that I didn't mention that we should have covered, or you think that's good?
I think it was awesome.
All right. Well, listen, Vincent. We have a whole bunch of listeners that, if they want to find you or follow your stuff, where can they find you?
Best place to go is, well, if you're a client of StoneX, is to reach out to your StoneX rep and say, hey, I want to get Vincent stuff. If you're not familiar with StoneX, we are the largest financial company you never heard of. We're Fortune 100 company. We have pretty much our hands on in everything. Initially, it was commodities, but now we do everything: options, ADR, securities. Rapidly growing. Stock has been on a tear. So talk to us. And then if you cannot talk to us, yeah, Twitter is great. My handle is at Vincent Deluard, VincentDeluard. Under my profile, there's a pin tweet where you can sign up for a free trial. You can also reach out via DM. I try to answer them.
Yeah.
And then podcasts. I mean, it's just great. I mean, I hope Kevin can come back and
Oh, Kevin loves chatting with you. You're going to be on the huddle back in no time. It's uh, it's always a pleasure, Vincent. Thank you for joining us so much. This is where we'll wrap up today's market huddle. Thanks all our listeners for tuning in. There's a very good chance that Kevin may make appearance in the next huddle episode, but we'll keep you all up to date on that and see how that goes. Anyway, thanks everyone, and we'll catch you all next week. Cheers.